So you've said the financial system is inherently unstable. What features make it that way?
Well, I think there's several features because the process of intermediation, bringing together, lenders and borrowers, typically involves a number of functions that are part of the financial system: liquidity transformation, leverage, maturity transformation. And so when you combine those things, you get a shock to the financial system. Then people have to unwind what they've done. And when things are leveraged, you get what's called pro-cyclical behavior, which means that the initial impact of the shock gets magnified by the inherent problems in the financial system. So, if people have to sell things, if people have a leverage that has to be unwound, then it tends to amplify the impact of that shock. And that's what makes the financial system unstable.
So thinking about that, what tools, for instance, requiring banks to hold more capital or countercyclical capital buffers can ensure a resilience of the financial system? And what methods do you think are best?
Well, capital and liquidity regulation have clearly helped. So capital actually has two roles. One, it gives you a buffer against shocks and losses, but it also reduces the leverage, the inherent leverage in the capital structure of financial firms. The more capital they hold, the less leveraged that they are. And so that's a good thing. But think about it, the leverage is typically now only 10 to 1 instead of being some multiple of that. Where we lack things is typically in markets, because markets can be unstable as well. They can be vulnerable to shocks, and they can exhibit unstable behavior. And so we need to think about making our markets more resilient too. And one key market is the money market, if you will, or what we often call short-term wholesale funding. That's on the liability side. We've done some things on money market reform. That's good. We need to do a little more, perhaps. The repo market, we've done some things there with the tri-party repo market. But we can still do more, and there are some proposals out there to look across those markets, like minimum floors on haircuts, to make them more stable. We have to really think about how to implement those changes and whether or not they're worthwhile.
So how would that work exactly?
Well, if you have secured funding, typically you have to post collateral against your borrowing, and the collateral basically over-collateralizes the loan. In other words, you post more than the amount of the loan, and the difference between the loan and the amount you post as collateral is the haircut. And so the bigger the haircut, the more cushion there is for the lender to seize back the collateral in the event of a decline in price or some problems affecting the loan. What the FSB and others have proposed is to increase the size of those haircuts so that they don't get too big or too small, rather, in good times, and then they don't get too big in stress times. And the movement of haircuts in that fashion can be very pro-cyclical. So if we put a floor under them, that is to say, keep them at some minimum, then we can reduce the pro-cyclicality inherent in that kind of funding.
Do we have the tools to know when risk has become systemic?
We have some tools. We're better equipped now than we were in the past because we're more aware. We have improvements in data. We have improvements in the tools. I think there's promise also in some new tools to try to understand, when risk is starting to spread across the system, which is really what you mean by systemic. And to do that, we need to assess the interconnectedness of both firms and markets across the financial system, and between the financial system and their non-financial counterparties, the borrowers and the savers.
So what are some of the new tools?
Well, some of the new tools involve stress testing of CCPs. We have central clearing now in CCPs.
What's a CCP?
A centrally cleared counterparty.
Okay.
Central clearing has a lot of benefits for derivatives. People can use the netting that's inherent in the clearing process to reduce counterparty risk for them. It mutualizes counterparty risk across the system and concentrates it in the CCP. And if you have the right governance, the CCPs have resources in case counterparty defaults, then it can actually reduce counterparty risk. it also transforms that counterparty risk into liquidity risk. So we need to understand better the whole process of that risk transformation. But we're not.
So it creates liquidity risk or it decreases liquidity risk?
It creates liquidity. It transforms counterparty into liquidity risk. Because the CCP agrees to make timely payment on the obligations of its clearing members. And so the clearing members delegate that to the CCP by virtue of the CCP becoming a buyer to every seller and a seller to every buyer. And this is getting a little bit into the weeds, but the point is we have now more tools, we have better data to understand some of these things. There's been some stress testing across CCPs, both by the Europeans and by US regulators, the CFTC. And those are good things. And we're doing more work to understand what the nature of that risk really looks like. Is the CCP resilient? Are the clearing members resilient? What about the interaction among them all? Is it, you might think, for example, that the biggest clearing members would pose the biggest threat to a CCP if they defaulted. Well, that's generally true, but it's also the case that if you have somewhat smaller clearing members, or even counterparties of the clearing members themselves, if they default, then that can cause problems. So we're doing more work to understand all of these things, and yet it's an ongoing process because the financial system is always changing. Financial innovation is a constant, and so we need to try to keep up with that, if not get ahead of it.
Yeah, I guess it's a challenge because to some degree this is a newer structure, and you don't know how it works until it doesn't.
Right, that's right.
So, what avenues of academic research might help regulators and bankers anticipate these new risks?
Well, some that I just mentioned, more research on interconnectedness. To do that, you need better and more granular data. And those data are often unavailable because they may be proprietary or they may be confidential. And so the trick is to figure out how to make them available without revealing the confidentiality in the data. And there are ways to do that. And so we're looking into things like that. I think a lot of the research that's going on at this conference can help people understand how the risk may travel from one part of the financial system to another. And more particularly, how risk that shocks the financial system affects the economy and what the feedback from the economy back to the financial system looks like. So that's something that we've done some work on, both in academia and in policy circles. I spent a lot of time thinking about those issues, but more needs to be done.
Sounds a lot like cyber risk.
Well, cyber risk is an interesting case because it's hard to quantify. We're thinking about ways to quantify it, and some of the things that may be discussed here are going to be helpful in that regard. And we're also we're unsure of how those risks or shocks from cyber events and broadly operational risk can change and affect other risk. So if you have a cyber shock and somebody's data are compromised, and people can't get access to their information, then transactions may grind to a halt among those people whose data, to whom the data belongs. And so that's obviously important. It affects trust, it affects confidence, and has spillover effects that we haven't quite figured out yet. But everybody's aware of it now, and so a lot is being done.
Yeah, that sounds like a research area that's right for...
It is.
Yeah, and another area where data is hard to find.
Data are hard to find. It's getting better. Thinking about ways to measure and then create data for these cyber events. And then not only to create the data, make them and make them coherent, but also to make them available to share them. And up until this point, there's been reluctance to share some of those data, simply because many firms don't want to admit that they've been the victim of a cyber incident. But if they can do it in a way that doesn't involve reputational problems or shame or embarrassment, because everybody's going to be subject to it, then that's progress.
Yeah, and even regulation that makes data sharing harder. So
right.
So I guess in that vein, what improvements are needed in financial data or cyber data, and what are those?
Well, we have some guidelines on how to make improvements in financial data because My view is that people who manage risk inside financial firms and outside financial firms and non-financial firms, they need information, they need data in order to manage their risk. They need to be able to measure the risk, they need to identify it, identify the sources of the risk, and be able to quantify it and then take steps to mitigate those risks. Those data should be shared with regulators. Oftentimes the regulators are not using the same data as the risk managers, and yet there are guidelines on how to do those things. From the Basel Committee on Banking Supervision, there's a famous document called BCBS 239 that outlines principles for reporting and aggregating data on risk. And only about half the banks around the world have done that so far. More needs to be done, I think, there. And then when you stop to think about it, similar or analogous principles apply to non-bank financial firms. And that is an even broader landscape because, particularly in the United States, 2/3 or at least half of financial intermediation occurs outside the banking system. So there's a lot of work to be done there.
Do you think to some degree it's like a collective action problem? It's like you need everyone's data to
Absolutely
understand how
is.
it all is, but no one really has an incentive to share the data, especially, you think of even like with JP Morgan's London Whale. It's like you find out you have a loss and you'll get so much flack for it.
Right.
But it's important to know that information. Collective
Collective action problem is exactly the right word to describe it. There's a law professor at Columbia with whom I wrote a paper on this issue. Kate Judge and I wrote a paper on the data standardization challenge. Data standards are important because they help to make the data coherent and to improve the quality of the data. So the quality issue is a big issue. Getting the right data is a big issue, and making sure at the same time that if we have data that we're collecting and we don't use in the policy community, we should stop collecting them. Don't do stupid things.
Yeah.
And then making the data accessible in a way that preserves their confidentiality and security.
Can, say, big data, AI, and machine learning help us detect and monitor risk?
I think there's the promise of that. I think there's also a lot of hype surrounding that. There's a narrative that says, now that we have all these neat tools and big data and we can scrape websites and so on, and we don't need to worry about the quality of the data, the tools will take care of it. I think the opposite is true. I think that the more that we ask of our data, the more that we need to have them coherent. And what we can do is use some of these tools to help us work our way through the data to add coherence to them. So, for example, just think about data standards. If I want to know the parties to a financial transaction, then even for the same firm or legal entity within a firm, it may be that the data are identified using one of half a dozen names. And I have to think, is JP Morgan Securities the same as some subsidiary of JP Morgan Securities? And the answer is, well, we can find that out, and those new tools can help us. In addition, we can probably use some of these new tools as early warning indicators to help us look for patterns. Patterns don't necessarily mean that we understand the causal relationship, but the patterns can help us observe what's going on in the world. So we need to use induction and deduction, both in concert with each other to help us solve these problems.
Yeah, it sounds like it's necessary just because if you're looking for systemic risk and it's more of a global economy where there's so many more transactions, it sounds like you're going to need a lot of new tools to keep tabs on that.
Well, I never saw a tool that I wasn't willing to look at.
Yeah.
Not all tools are created equal, though. So
that's true.
You need to, and tools themselves may have problems. So artificial intelligence, for example, great promise to help us uncover things that we haven't seen before. But we don't want to be hasty in drawing conclusions using these new tools because they may be biased, just as we human beings are biased.
Well, they magnify our bias.
They may. Exactly.
Interesting. So, does financial innovation affect business models, market functioning, policy choice, effectiveness, and the way we model? How does it affect how we model?
I was going to say all of the above. Right. The answer is it should, because we tend to be comfortable in modeling things the way that we've always modeled them. We look back in the textbooks, we learn, we implement what we learned in graduate school or in seminars and workshops and so on. But I think the workshops need to push the envelope in thinking about how business models are changing. So just think about it as something really simple, like FinTech. Is FinTech so radically different from other kinds of finance? Well, in some ways, no, but in some ways, yeah, there are differences. So it's faster. It is footloose. So when we think about, any geographical or spatial aspects to financial activity, we're not quite sure. In FinTech, where it originates, it may not even matter from one standpoint, but from another, the location may matter. We may want to know who we're dealing with. And so all those things, those particular aspects, the speed and being footloose, and the way that things are changing quickly, I think those have to affect business models, or they are, and we need to take that into account in our modeling, if we're not already.
Yeah, well, certainly. So financial innovation usually is, I think of financial innovation, which is different in nature from the 70s, which certainly was about making the system less risky, but also created new risks, because any new innovation, even,
right.
Like a seatbelt, makes driving less risky, but also enables you to drive faster.
It may encourage more risk-taking.
Yeah, or even financial derivatives, which are effectively insurance, they can also be used to take more leverage.
Sure.
So, do you think that the FinTech now, do you see it posing sort of safety and risks too?
It possibly can. First among them is operational risk. So, if we're increasingly reliant on the technology piece of it, and technology, is like anything else, it may break, then, we need to be cognizant of those things. We need to be aware of the cyber issues surrounding FinTech. We need to be aware of the biases involved. We need to be diligent about thinking whether or not there are everything we see on the surface is actually what's going on. But that's true generally for financial products.
Yeah.
And it's just that FinTech may mask some of the things in a way that's different and harder to detect.
Yeah, it's interesting. I haven't thought about it until you brought it up. It seems like the FinTech now is more about, operations as opposed to creating new markets.
So far.
Yeah.
But, there are new markets out there
that
are being created with technology. And so, there are issues like initial coin offerings, right? How should those be regulated? How should investors look at them? What's the value proposition in these things? How are they traded? How are they liquid?
Can they be regulated?
Can they be regulated? Well, the SEC a couple of years ago, put out a kind of a white paper on this with regard to a particular transaction. I think it was, I can't remember the name specifically. I think it was something like Dow. In any case, they said, well, it basically quacks like a security and smells like a security and moves like a security, so we think it's a security. But other people, legal scholars, may disagree with that. And so it's not settled law.
Even if we should, can we? If it's the whole point of it is it's anonymous, can this be regulated?
Well, the question is, why do we have regulation? Right? We have regulation because markets may fail. And if there's a market failure, then, government has a responsibility to look at that and see whether or not we need regulation. And we have regulation because we want to protect people from, abuse. So we want to protect consumers. We want to make sure our markets are fair and efficient and effective. We want to make sure that they're resilient. Those are all good reasons for regulation. The question is, what kind of regulation do we need in these new markets and these new products? We don't know the answer completely yet.
Yeah, and I suppose it's questionable if Bitcoin and all blockchain poses systemic risk yet anyway.
Well, it's not big enough.
Yeah.
So, size matters. It's not the only criterion for thinking about the systemic footprint, if you will, of a particular market, a particular product, a particular institution. But it's important. So, and then there are lots of other questions related to it that we don't quite know the answers to.
Well, thank you.
Thank you.